Today's Cardinal lesson, we're talking about risk and we're talking about getting your money, getting you invested at an appropriate level or an acceptable level of risk. I'm still talking in tongues a little bit. And I just think a lot of this investment speak just confuses the daylights out of people. And it's an important part of what we do with every new client and ongoing with clients is to get an assessment to determine both objectively through a process where we're going to assess them and have them assess themselves as to how much risk they actually should be taking and that they want to take. And you obviously take risk for the reward. I mean, you invest in stocks, you invest in a basket of stocks, you invest in a mutual fund, and you have the risk of losing money. And you take that risk so that you have the possibility of a substantial return. And so that whole process is really what we're talking about today, which is risk assessment. And so now I want to go to Tom and I want him to just talk a little bit about this from his perspective.
Yeah. And so this is an important piece of what we do when we're working with prospective clients or current clients because we want to get a sense of how much risk they're comfortable taking because there is that relationship. The more risks you take, you would expect to have a higher return over time. And what we have found a lot of times is people come in telling us one thing: I'm comfortable taking risk. I've always taken risks. I'm okay with the fluctuations. But from a behavior standpoint, when things actually are happening, they're the ones calling us up, wanting to sell all their stocks, wanting to get out of the market. I mean, their behavior doesn't always line up with what they're telling us they are. And so, what we'll in the show notes, we'll get there in a second, is we have some questionnaire, and there's other software that we can use to really try to give us an objective way that people view the risk. And oftentimes, it's different than what they tell us. And so, and part of the reason behind that is a lot of people, they're coming us right when they're turning 65, they're retiring, going on Medicare, and they have taken a lot of risk in their early years. Like personally, like I'm young, I'm taking a lot of risk in the investments. And it doesn't much matter. I mean, I know over time it should go up. The fluctuations now don't matter too much to me. Just don't sell it, leave it invested. I should be fine. And that's what they've done is I've always stayed the course. I've never sold out. It's worked out well for me. And then they get to 65, something like this year in 2022 happens. The markets are down and they're freaking out. They're saying, I can't lose anymore. I'm about to retire. And they start selling everything. And so that's just a sign to us that what they're telling us they're comfortable taking doesn't line up with what they're actually comfortable taking. And that sets you up for not a great investment experience moving forward. We want to make sure we're investing towards what their actual risk tolerance is, not what they have maybe done in the past.
Well, the first stock market crash that I lived through, I was just about your age. It was the stock market crash of 1987. I didn't worry about it much either. I was almost 30 years old. I actually threw a bunch of money into the market at the low there, like October 30th, 1987. And, I'm now just who you were talking about, people turning 65. And it's just a whole different ball game when you're facing retirement and you're facing just where you're not going to be contributing. You're going to need to live off of this money. So the whole process of what we're talking about is to find out what's appropriate for you. And age isn't the only thing we look at. It's a whole bunch of factors. And I really want to just go through those and all those risk assessment tools.
Yeah, and one thing I'll point out just real quickly too is this changes over time. So because you've done this a couple years ago, 10 years ago, 2 years ago, I mean, this updates. I mean, as you get older, as things change, your feelings about reward versus loss, I mean, those change. And so it's appropriate to do this every couple of years, especially if you're getting close to retirement, just to make sure that we're still staying in the appropriate risk that you're comfortable taking.
Okay, so new clients coming to us, new prospects, we put them through a process. And we're going to go over the process, Tom is, in just a sec. We're going to talk about, so these factors. So we're going to look at your net worth. How much, what is your net worth? How much value, assets minus debts equals net worth. What is your liquid net worth? If you had to put your hands on the money and start selling things and create cash, how much could you do that? What is your income? What's your income now? What's your income going to be in retirement? We're going to look at your tax bracket and see where you are now, where you're going to be in retirement. Um, and, that's important. And it's also important whether we're going to put you in taxable investments or perhaps tax deferred investments or like a Roth, a tax free investments. Uh, we're going to look at your age. We just talked about that a little bit. And most of our clients tend to be in the 50s and the 60s and the 70s, which is entirely different just across folks and across lines as people when they're 30 and 20 and 40. So your age, we're going to look at your marital status and see whether this is a joint income household or, two Social Security checks, two IRAs, two 401ks, or just one. Um, we're going to look about when you expect to begin withdrawing. So how many years are you away from retirement? Or like in Tom's case, he's 30, 40 years away from retirement. I'm, on one hand or two hands away from retirement. So we're going to be just of when we expect to withdraw money from the account, um, when that is. Who and what is this money for? I mean, some people, their money in their 60s is to leave to their kids, and they might live to 90 or 95. So, who and what is the money for is a factor. We're going to look at your investment experience. How savvy are you at buying and selling stocks and mutual funds? And what is your history in terms of losing money? Did you have money invested in 1987 and that you lost? Did you have money invested where you lost in 2000? Did you have money invested where you lived through 2008, 2009, or one or both of those? And what did you do during those periods? Did you gain money all through the last decade or two, decade and a half? Um, and then how did you react? And a lot of this becomes subjective, where we just get a sense from you whether you're a savvy investor, so you even know what we're talking about. Risk tolerance is really more of of something, a result thing. Because if you just ask somebody, what's your risk tolerance? I mean, we have a way of objectively asking you some questions of what you will do or what you did do when certain things happened. But we go through these factors and more, and we have some objective assessment tools that require us, the advisor, to add subjectivity to it as well. Um, you're part of the process, so you're part of the decision making process of really arriving at a number or a category. So now over here on the right side of the board, I want to go to the show notes actually, if to talk about these 5 different categories, and I want to push it in there and get where we've. Let's go down, Tom, to the middle of the page, and in our risk assessment tool that we use at Brookstone, it just shows that we score you. This is kind of an oversimplification, but we're going to put you, or you're going to put yourself through these questions in one of these 5 categories. And, that's going to be conservative, where you're interested in preserving principal and you're willing to accept lower returns just to know your money's safe and you're not going to lose much or anything at all. That's a category that a lot of people end up in. Moderate conservative, is just adding some risk, but still not that far from that. Moderately aggressive, and aggressive is going to get to the point where, you're pretty much putting all of this portfolio that we're talking about at risk. And we have a fair number of clients that come to us that are already here. We can tell that just looking at their stuff and listening to them. And but when we're listening to them, they may not be talking like they're here, but they when we get done with them, generally because of their age and their years to retirement, we're going to suggest that they move and become a little more conservative. Likewise, we have people that tell us they're here, but they're really kind of here. And and so this is a whole process. I want to go to Tom and I want him to talk about really the tools that we use to do this assessment.
Yeah, and so the form that we have in the show notes is one of the tools that we use. Again, the show notes, you can find them in the link below of the video. They're also on our website, but it goes through and gives a little more detail behind the board. But the first one is this risk profile questionnaire from Brookstone. They produced it, and it gives us some objective questions to ask, and then the clients answer to give us some number where it's not just based off of what they think they're doing. And we have a lot of clients that will come in that one of the questions we'll ask, okay, how comfortable are you with the amount of risk you're taking? And a lot of them, they don't really know how to put that. But once we get talking, it's clear that they are telling us that, oh, I'm comfortable with risk. I want to be aggressive. I want to earn the money. But when they come and answer this question, they end up in like the moderate or moderately conservative portfolio. So when there's that mismatch, we really need to we need to have a conversation around that. It's like, okay, you tell us this one thing, but based off your answers of what you would do if these things happened, it doesn't line up. I mean, there's something missing here. We need to get you invested more appropriately to what your actual risk number is. And so that's what this questionnaire is helpful with. It's not the end all be all. We don't solely go off this. I mean, we want to listen to the clients as well. And there's some reasons why you might have some money more aggressive, some more conservative. They might be used for different things. But this gives us a starting point to really have that conversation around that. Another tool that we use, and it's also a brochure of it's in the show notes, is what's called Riskalyze. This is software that does a similar function where you can go in, answer questions that will give you a risk score of like what you're comfortable taking. Then we can plug in your investments into the software, like the holdings, and see what your current risk score is versus what your investments are versus what your score was when you answered the questions. And then we can propose some changes, look at the proposed portfolio to get you more aligned with your risk score. So we use this a lot too to get people a sense of kind of where there's that mismatch. Ideally, what you would be is you'd answer the question, you'd come in with a risk score of whatever that number is, whether you're aggressive or conservative, and your investments line up with that risk score. You want those to be mirroring each other because that means that you aren't going to be making rash decisions when markets are fluctuating. When they're going up, they're going down. You're going to stick to the course, and there's a lot of research that shows that that's just the best strategy is get invested appropriately now, stick with the plan, and just hold on, for the ride. So what we want to do is want to make sure our starting point is the appropriate spot.
Yeah. Well, it's just this is a give and take, and this is an ongoing process. Once somebody becomes one of our clients, we use this in the process of making them or them becoming a client, but then we continuously do this throughout retirement. And frankly, most people end up somewhere around here, somewhere around the middle. And those are people with some pretty substantial money, typically, that are going to end up here. But even some of those end up here and here simply because they just don't have any reason to take a lot of risk. I mean, something that I'm always asking people, what's this money for? And I usually have to ask the question 3 or 4 or 5 times over several meetings when they've got a big nest egg and they got Social Security checks coming. Perhaps they have a pension. Many people don't these days, but then they're going to maybe not need that much of their portfolio, or maybe they can do without their IRA up to minimum distributions. And so I'm always asking people, what's this for? And one of the reasons I'm asking that, or who's this for? What's it for? How are you going to spend this money? Is I want to know, is there something worth taking risk for? Or is there something where we want to avoid risk so that we're sure it's there, whether that's to pass on to their kids or to pay for their long-term care in the future or to take care of their surviving spouse? where they're going to be, in a bad situation or a compromised financial position. So there's all kinds of reasons that people will, after some thought, attach to their nest egg. And what's the money for? Because we want to have that, because we want to know if you're taking risks, there's got to be a reason to take that risk. There has to be a desire. Or if you're going to avoid risk, that's to protect the money. So, it's both an objective and a subjective process.
Yeah,
So,
and I think that's a good point, is that the risk tolerance, that gives us one data point. It's how much risk are you comfortable taking? But there are other factors that go into that whole decision. Some of the two ones, and we won't go too far into this in this video, but one is risk need. How much risk do you need to take to have a comfortable retirement? So, for example, I'm young, I have many years to retirement. I need to take that risk. I need to have those earnings to support the retirement that I want long term. Whereas someone who's 65, they've done their saving, they have the investments that they have. They don't need to take a lot of risk in a lot of situations. And then the other one that we look at too is risk capacity. How much risk are you able to take? If we have someone that can live off Social Security by itself and they don't even need their investments, they have the ability to take a lot more risk too. It's not going to affect their retirement if it goes up and down. Whereas someone who needs their investments very heavily to live off of, they can't afford to take big losses there. So there's other measures that we look at. We might do another video on that. I think we've done one a while back on something like that. But and again, the risk tolerance is really an objective measure to figure out how much risk you're comfortable taking.
yeah, before we touch your money, this is the step we're going to take to get a sense or make any recommendations. Um, this is the process that we're going to put you through. And with that, I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening today.
Thank you.